valuation language for the boardroom M, and A, recommendation phrasing. Welcome. Today we're sharpening how you present valuation in the boardroom. The goal is simple. Be concise, confident, and decision-focused. Executives don't want a tour of your spreadsheet. They want the call and the why. Lead with the headline, then back it with numbers that matter. Finally, translate analysis into an action the board can approve. Think, here's the value, here's the range, here's the price, here's the risk, here's the go, no-go. Short, strong, and specific. Let's turn good analysis into a clear decision in minutes, not meetings. State the range first. We assess equity value at $X $Y. No suspense. Then briefly explain the methodology mix. For example, DCF, trading comps, and precedent transactions. So directors know the range isn't a single model guess. Finally, flag the key drivers that move value: growth, margins, and WACC. For instance, a 2-point margin swing shifts value by $150, $200 million. A 1% WACC change moves $250 million. Clear range, clear methods, clear levers. You're telling them where the number comes from and what can bend it. Make the ask. We recommend offering $Z per share. Then show how it fits the range. $Z equals the midpoint, plus strategic premium for control and scarcity. Keep the logic crisp, no data dump. Clarify the rationale in a line. Expected synergies, asset scarcity, and control benefits. Example: $Z prices in $120, $160 million run rate synergies, and a 10% scarcity premium for a unique data asset. You're not begging for approval. You're setting a professional anchor that aligns with both the math and the strategy. Lay out 3 scenarios: base, upside, downside. In each, state revenue, margin, and cash flow impacts. Then quantify sensitivities. Plus or minus 1% WACC shifts value by $250 million. Plus or minus 100 bits per second margin changes value by $120 million. This shows what truly moves the needle. Finally, set decision guardrails, a walkaway threshold where returns fall below target. Example: if price exceeds $Z plus 10%, ROIC drops below WACC by year 3. Recommend WACC. Give leaders an informed range, not a rosy single point. Define success with hard tests. Example: value accretive above cost of capital by year 2. Show immediate return strength. ROIC exceeds WACC by X BPS at close based on identifiable synergies. Then draw a bright line. Do not exceed $Z without verified synergies signed in the integration plan. These rules tell the board you have a spine and a calculator. Discipline wins credibility. If the price or timing can't clear these hurdles, the recommendation automatically adjusts. No emotion, just economics. Name the top 2 to 3 risks clearly: integration complexity, customer churn, regulatory delay. Tie each to a mitigant and a metric. Example: integration right, pointing arrow stand-up day 1 TSA. Track synergy run rate versus plan monthly. Churn right, pointing arrow price hold for top 50 accounts. Monitor net revenue retention. Regulation right, pointing arrow staged close with break fee. Monitor approval milestones. Use conditional phrasing to keep decisions crisp. If integration slip exceeds 90 days, then adjust synergy realization and reduce price by $X. Risk named, owned, and priced. Choose verbs that move decisions. Recommend, support, expect. Avoid hedges like maybe, seems, might. They weaken your ask. Quantify wherever possible. We expect plus $A minus $B NPV from synergies. Or, we recommend a 12 to 14% IRR gate. Replace fluff with numbers and actions. Not, we feel the deal is attractive, but we recommend proceeding. The deal exceeds our 12% hurdle with a 200 to 300 bits per second buffer. Precision signals confidence and helps leaders compare options fast. End with a clear request. Approve up to $Z. Proceed to confirmatory DD. Then list next steps and timeline. Finalize customer calls in 2 weeks. Complete legal diligence in 3. Negotiate TSA by week 4. Finish with a one-line summary of value, risk, and conditions. At $Z, value is supported by synergies and scarce assets, risk is contained by staged close, and approval is conditioned on churn tests and regulatory milestones. You've made the call, set the plan, and framed the boundaries. Now the board can act.